Hello and welcome back to the channel. Today we're going to dive into the market trends for U.S. housing in the United States. First, we're going to look at mortgage interest rates, which are very important. Then we'll look at absorption rates, and we'll describe what that is for you. And then finally, we'll look at what we can anticipate for the future. So, let's get started. Tom Mason with West USA Realty. There are a lot of different things that impact our market and housing, and I know people are chomping at the bit to get
It's champing at the bit, not chomping at the bit.
out there and buy a home, but prices are too high and interest rates are too high. So first, let's take a look at mortgage interest rates to find out what direction they may be heading. If you were alive back in the 1980s, you might remember 18.29% mortgage interest rates after the big recession in the 70s, the stagflation that occurred. Since then, we've seen a precipitous drop, particularly since the pandemic, where we saw mortgage interest rates fall because the Federal Reserve was really lending money at no interest rate whatsoever. So the secondary mortgage market added 3%. I mean, during this time, you could have got a mortgage as low as 2.65%, particularly in FHA. But since then, since the recovery and with inflation that really picked up in 2021, we saw the Fed raise rates to try to stem inflation, and we got the high interest rates we have today. Now, inflation has been coming down. If we look at the one-year chart, we'll see in the latter part of 2024, we saw drops in inflation from 9% down to 5% to 4% to where we're at today at about 2.8%. And during the latter part of the last administration, we saw an enormous amount of spending occurring, with $2 trillion worth of debt in just 1 year. And that caused the Treasury Department to have to raise rates in order to attract buyers to buy our debt. And so interest rates went back up again until the election on November 5th. But overall, since January, we have seen this downward move as inflation has begun to subside again slowly and slightly and trying to get prices back down. At the same time, we do see an intention with the current administration to try to cut spending, which means the 10-year Treasury can drop because we don't have to entice people to buy as much debt as we had in the past. So these things work hand in hand, inflation and our debt, to determine two sides of that coin, how the 30-year fixed mortgage rate is going to perform. So hopefully we're in a recovery trend, but we won't know that until a couple weeks from now, because the first quarter of 2025 is about to end. We're going to start getting economic data from that first quarter, and then we'll see what happens in April. So now that we know what interest rates are doing, how's that impacting the market? Is it having any impact at all? Well, this map is going to show you Zillow's market heat index, and you can see that in places like Phoenix, it's a little bit colder. In Florida, it's really cold, and that may be due to some overproduction of housing in that area during the Great Migration post-pandemic from places like New York and California, who are actually losing population. In the meantime, in some of these coastal areas where you have stronger governments, more regulations, you tend to see fewer homes being built, even for the population, even though the population is starting to dwindle. But there are hot spots in the Northeast. You can still see, like Seattle, Washington, Bremerton area, still have high demand for housing, which means the absorption rate is really high. And the absorption rate is really easy to calculate. You take the number of homes sold, divide that by the number of homes on the market at any given time. And that's an important statistic to know whether you're a buyer or a seller. Because if that rate is below 15%, then we have a strong buyer's market. But if it's above 20%, it's a seller's market. And the higher it goes above 20, the stronger the seller's market. The number basically represents how fast homes are being absorbed by buyers in the marketplace at any given time. So the higher it is, the better it is for sellers. And in these cooler areas, you're going to see lower absorption rates for these homes. But since I'm a realtor in Arizona, I want to look at the largest metropolitan area in Arizona, and that's the Phoenix area or Maricopa County. Now, I've taken out some of the extraneous cities that are on the outskirts and just looked at what's active, sold, under contract, and also look at the sold to list price ratio, because this tells you what percentage of what you're asking for as a seller you're probably likely going to get for your home. And back in 2023, even though it was a poor market, we see 99% of what people were asking for they got for the home. Now we're down to about 98% on average. So expect about 2% less than what you're asking for if you price the home right. And so we go back 2 years and look at the price per square foot for the last 24 months. And I like to use the median better because average can be skewed by high priced properties. For median, we're at 248.66 in March of 2023. In March of 24, we went up to 258, and today we're at 264 median price per square foot. So we see an increase in prices over the last 24 months, continuing even though it's not a great market for sellers or buyers because of the prices. And absorption rate is what we were focused on before. And again, remember, if you're 20%, you're in a balanced market. Currently, we're at 23.9, 24%. So a very slight seller's market in Phoenix right now. And you can see the absorption rate itself is lower than it's been for the last 4 years. At the same time, the months of supply, the blue line, we see supply growing. And with the amount of homes in the marketplace, if you're a buyer right now, you have a choice of a great variety of homes, and you probably have some motivated sellers. To take a look for the market statistics overall, we'll see new listings coming onto the market, which is actually down from a month prior, but up 12% from a year ago. Active listings are up almost 7% and up 42% from a year ago, which we saw in that last chart with more properties coming onto the market. Under contract is up from last month, but down from 12 months ago. So more active listings coming on the market, fewer under contract, although from a year ago we see pretty flat on the number of sold listings. 1 month ago, they're higher than 1 month ago, but we really look year over year for comparison. Average days on market is down from 1 month ago, but up almost 20% from 12 months ago when we saw the average days on market in the 50 to 60 range. Now, average days on market, putting on the market and closing out the deal, finding a buyer, going through the inspections, having it appraised if it's needed, and then finally closing that deal, taking up to 77 days. So if you're a seller, you have to plan ahead and start putting that property on the market with enough lead time for your move, either downsizing or moving out of state. Unless you really price it well, then you're going to see your days on market will drop. And I did a previous video about pricing the home right in order to sell it quicker. There's 5 tips on how to sell your home faster. We start looking at price per square foot. We want to take first we're going to look at new listings. Properties that just came onto the market. You can see this slow incremental increase, a little bit of a dip here in December. Again, people take properties off the market in December, as you can see it back here as well. A little bump in January, but that new listings, they're settling down below 290 average price per square foot. What the active listings, ones that have been on the market longer, we see are well below 280, not well below, but below 280 for the average price per square foot. When it does sell, you'll see it does drop below 280 per square foot. When you look at homes for comparison, like I do, when I'm doing a comparative market analysis, I'm looking for the sold price. I don't really care about the under contract price. I mean, I might include one of those as a comparison if it's a very like property to the one that I'm listing, but sold prices are much more important. That is where you're probably going to end up. So far, we've looked at the market around the country and in Phoenix. We've looked at absorption rates in Phoenix itself. The final thing I wanted to cover is what could happen in the future. Well, I don't have a crystal ball, but we do know a couple things are going to happen. Number one, on April 2nd, we have tariffs going in place with other trading partners around the world, and that intent is to get manufacturing to come back to America. But in the short term, will that raise prices? Will that cause some concern with household finances? This chart shows us how many Americans are currently delinquent with their credit card payments, and we can see this makes a lot of sense. This was the big financial crisis we had with housing back in the 2008 area. People were using their credit cards up. A lot of delinquency at 6.5% is considered a lot of delinquency on credit card payments. For instance, right now with the current delinquency we have here, lenders have written off about $46 billion in credit card payments. Then we saw a recovery, everything smoothed out, about 2.5 to 2.5% is pretty normal on delinquencies. And then the pandemic occurred, and what happened? People stayed in, they didn't go out to eat, they didn't go to shows. So credit card payments were not a burden anymore. People were able to save a lot of money. Americans saved a lot of money during this period, and then inflation hit. And inflation caused us to use credit cards again for common household expenditures. And as we came over to the end of this, we see credit card delinquencies are starting to drop down, but they're still higher than we want them to be. They're about the same as they were 13 years ago, just after the big economic disaster. So still higher than the 2 to 2.5% range. And we can see this chart from the Federal Reserve that shows us just that. This is the column for credit cards, and we saw during the pandemic, Credit card delinquencies dropped to 1.5%, 1.5, 1.6, 1.8. This is where inflation started picking up. Went up to 2, 2.9, over 3.1, 3.2, and last quarter, the third quarter of 2024, we were at 3.2% delinquency rate. Now we've dropped down to just above 3%. At the same time, let's look at residential real estate. Before the pandemic, delinquencies on mortgages were at 3.5%. They dropped down to about 2% as the economy improved in 2018, 2019. Wages went up higher than inflation, and then we hit the pandemic. And during the pandemic, people were getting much lower interest rates. Even though prices went up, the interest rates were so low that delinquencies fell significantly. And now, today, even with prices high for residential real estate loans, the delinquency rate is lower than it was prior to the pandemic. So people are making smart decisions about when they buy and what they can afford and what their household income looks like. And a lot of people are renting right now, waiting for interest rates to break or prices to come down. We'll see in the next quarter, which the current quarter ends at the end of this month in March, and in starting the next quarter in April, let's see what kind of movement occurs in the marketplace and see if it's the time to get in. Right now, there are a lot of properties on the market. You have your choice of what you want to go look at. Even if you get pre-qualified right now, you'll find out what you're able to afford and go look. And if you want to wait, you can wait. That pre-qualification is not going to hurt you. You stay with the same lender. They can do pre-qualifications without impacting credit scores, like the good lenders can do that. I have a couple that you can work with if you'd like. Just ask me for their name and number and I'll send it to you. Leave a comment below and I'll DM you that information. But overall, I hope this information is helpful to you in thinking about real estate and getting that home that you're going to build generational wealth, build equity, own something. Stop paying the landlord and start paying yourself. And don't forget to like, subscribe, and share this with other people who may be interested in this information. Thanks a lot for stopping by.